Wouldn't it be amazing if we could predict the future? Imagine how easy life would be if we could ask an 8-ball which crypto asset would shoot to the moon next, or who would win the next FIFA World Cup. But then where's the fun and the thrill in that? Even though we can't predict if Ronaldo will still be around for the next World Cup, we can still confidently say that there are a few things that will hold true in all the possible futures of our world. Like the sun will rise in the east, pineapples on pizzas will never taste good, and, more seriously, borrowers will always want the cost of borrowing to go down. In a world that revolves around capitalism, the cost of borrowing play a massive role. Until now, reducing these costs have been difficult because of the archaic and opaque nature of the traditional financial system. But with the advent of blockchain technology, all of that is about to undergo a revolutionary change. Welcome to Leapfrog, a channel dedicated to making animated explainer videos simplifying crypto and decentralized finance. If you're new here, be sure to subscribe so you don't miss our future videos explaining the magic behind the scenes of crypto. To understand how blockchains can help reduce borrowing costs, let's first look at how lending works in traditional financial systems. Banks give out thousands of loans every year, but where do they get the capital to provide these loans? They borrow it from other lenders. This is how banks and other loan providers typically operate. They borrow money at a rate of X% from lenders, and then loan it out at a rate of Y% to individuals. Their profit, then, is the difference between the two rates, that is, Y minus X%. Lower the borrowing cost X, higher the profit for the banks. Thus, to maximize their profits, banks would always want a lower cost of borrowing. Traditionally, this process of driving down X has been done popularly through a practice called securitizations. It is currently a $14 trillion market. Let's look at an example to understand how securitization works. Suppose Alice takes a loan from a bank to buy a house. She provides the house as the collateral, and the bank can claim the property if Alice doesn't pay back her loan. This type of loan is called a mortgage. Now imagine that there are 99 other borrowers like Alice who want a mortgage from the same bank. Let's say each of these mortgages is worth $1 million. In other words, the bank has loaned out a total amount of $100 million and has claims on their properties, also worth a total of $100 million. Each of the 100 borrowers has a different risk level. Some will pay back the entire loan on time, some will delay payments, and some might never pay it back. The bank pulls together these 100 individual loans to average out the risk of the entire pool. Then it creates shares against this loan pool, just like Amazon sells shares of their company on the market. These shares are called mortgage-backed securities, or MBS, and the process of creating these securities is called securitization. 100% of these newly created mortgage-backed securities are sold to different investors who then earn interest on their part of the loan shares. With me till here? Now, how does this process reduce the cost of borrowing? Imagine if there was no securitization. The bank would have to raise $100 million from other banks at a high interest cost, which would probably be close to Y%. This would have meant very low profits for the bank since X is less than or equal to Y. With securitization, the bank can raise $100 million at a much lower rate because now it has created shares out of the loans that can be traded on a market. Let's continue our example to understand this better. Say each of the mortgages was bearing a 10% yield. When the bank creates MBS out of this mortgage pool, suppose they create two different versions of the shares. Low-risk shares, which comprise 70% of the total loans, yielding 4% interest, and high-risk shares, which comprise 30% of the total loans, yielding 15% interest. Thus, the weighted average interest being paid to the shareholders comes out to be 7.3%. In other words, the cost of raising the $100 million for the bank is now down to 7.3%. Now, the customers are paying 10% interest on the loans, and the shareholders are receiving 7.3% interest. So, who earns the difference of 2.7%? From this example, it might look like the bank keeps the profit, but that's only partly true. In real life, there are a lot of intermediaries and third parties involved in the entire securitization process. Let's dig in. To set it up, first, the commercial banks sell the loans to investment banks. Investment banks then create a new company called SPV, or Special Purpose Vehicle, and sell the loans to it. This is done because the investment banks don't want to keep loans on their balance sheets. SPVs then create the mortgage-backed securities and sell them to the investors. Once the securities have been sold, the process flow looks like this. The original loan borrower, or Alice in our example, makes the loan payments to the banks. An agent sends these payments to the SPV. A custodial agent keeps track of loan performance. Another agent calculates interest due for each share. Another agent makes payments to the shareholders. Auditors review everything. Trustees create reports. And the list keeps going on. There are many more intermediary steps, agents, and Excel and PDF documents involved in this archaic process. And if that wasn't enough, all of this happens behind TradFi's opaque doors. Every step takes a portion of the profit, which is 2.7% in our example. Now, if securitization was to happen on a blockchain, it would cut most of the intermediaries by using smart contracts and NFTs. If this is the first time you're hearing those words, we made previous videos explaining both of those topics. The links are in the description below. Using blockchains, the securitization process could look like this. The borrower makes payments to the banks. US dollar is then converted to stablecoins for interaction with smart contracts. Instead of buying shares, the investors buy different risk-level NFTs. Smart contracts then distribute payments to the NFT holders. And that's it. No requirement for so many intermediaries. In addition to intermediaries, auditing and reporting agents are also removed from the process because on a public blockchain, all transactions are transparent and verifiable by anyone. Data can be extracted by running a simple query on the blockchain. On average, intermediaries add 1% to the total borrowing costs in traditional securitization. Doesn't seem like a lot, right? Wrong. At a scale of $14 trillion securitization market, even if the blockchains help remove 0.25% of cost, that would amount to $35 billion a year back in borrowers' pockets. The transition, of course, won't be immediate. But over the next 10 to 15 years, on-chain securitizations could really help bring down the cost of borrowing to its minimum. Certain DeFi protocols like Centrifuge are already replicating the core functions of securitization on-chain. As we end this video, we would love to see a conversation in the comments on what you think about this. What other use cases could the blockchains unlock? If you enjoyed watching this, make sure to hit the like button and subscribe to the channel. We make these videos every week and your support keeps us going.